Hi everyone, it is so good to be back and to see all of you here. I am very excited for today's video because we're going to be going over the third part of the strategy that I have used to pass 4 $100,000 FTMO challenges. So if you're totally new here, I've already made 2 videos, part 1 and part 2. So I highly recommend you go check those out, get those lessons under your belt, and then come back here and we'll go over everything that we're going to go over today. And today's video is exciting because what we're going to be doing is we're going to be taking all of the tools that we learned from the first part and the second part. So all of the technical tools that we have learned and now know how to use properly. We're going to be taking those, bringing it all together and figuring out how the heck we're going to place our trades. So it's really the execution part of the strategy that we're going to be going over today. So if you don't already have it, grab your notebook, grab a cup of tea or coffee, and we're going to get straight into it. So the question that I'm sure many of you have is, Matt, we've learned all of these tools, it's great, I know how to use them, but how are we going to actually use them to take a trade? And the answer to that the answer to that question is we're going to use all of these tools to build up a zone of confluence. So you need to get that deep into your brain. Remember it, zone of confluence is what we're going to be using these tools for to find out where we're going to take our trade. So then the next question is, well, how do we do this? How do we find this zone of confluence? The answer to that question is we're going to be using all of the tools that we've learned individually. So I want you guys to think of all of the tools that we've gone over, Fibonacci, trend lines, key levels, and the moving averages as a whole, but also as an individual entity. We're using them all together, never alone, but we're also using them individually, if that makes any sense. In simpler terms, it's not explicitly done this way, but I could say that just draw each tool on their own individually, and then we'll figure it out from there. You always draw them keeping other elements in mind, but for the most part, you can think about using them individually, drawing them and implementing them individually, and then we'll bring them together. So that's kind of how we're going to do it. Of course, this isn't rocket science. Some of you might be surprised at how in here. Some of you might be surprised in how simple this is. You draw your Fibonacci, there's a trend line that lines up with the 61 fib and there's a 200 EMA there. Boom, we're gonna be taking a trade right there. There's nothing else to it. It's really that simple. It's not always easy, but it is simple. So once we find these areas of confluence, what we're going to be doing is we're going to be setting pending orders. For the most part, 99.9% of the time, do not use market orders. And I really encourage all of you to stop using market orders as well if you're going to be following this strategy. Now, there's a few reasons for why we use pending orders. And when I've taken courses in the past and we spoke and I learned about pending orders, this was really one of the biggest aha moments for me. You see so many traders online on Instagram posting stories of these sniper entries, and that is kind of what we're going for here, and that's how they do them. It's by using pending orders in these areas and zones of confluence. So I really hope that by the end of this, you guys will be able to post those stories too, if that's kind of the thing that you're into, if you like posting that kind of stuff. Hopefully you'll be able to do just that. But in terms of pending orders, the first reason why we're going to set them is because it's going to allow us to enter the market at the absolute best price. There's a reason we want to get in at X price, and there's no point in using a market order, which won't be as efficient. Sometimes these areas hit in a matter of seconds and they move, and you don't get another opportunity to enter on a market open. So that's why we're going to be using a pending order. The second reason is because we're not interested, and this is really important, we're not interested in waiting for confirmation in our trade through price action. We're not interested in what the price action is doing in terms of whether it's going to accept or reject our zone. We're not looking for some type of bullish candle to confirm our bias of going long and then buying it from there. We're not interested in that. And the reason for that is using a market order increases your risk. So if you're waiting for confirmation and you get a bullish candle, and if you were to set a pending, you'd have, say, a 30 pip stop loss. and you get a 10 pip bullish candle, your stop loss now needs to be 40 pips, and so your risk to reward decreases, and essentially you're increasing your risk because of that. So that's another reason for why we don't want to use market orders, and we really want to use pending orders. And thirdly, another reason is because it takes out a lot of human error. Oftentimes, like I said, these areas will hit very, very quickly. They could also hit when you're sleeping, and you don't want to wake up at 2:30 in the morning and have to take a trade. And I have always had the most success with my trading when I've used pending orders rather than market orders, because if you're waiting for confirmation, it's a very subjective thing in terms of whether the candle is bullish or bearish enough for you, what kind of candle prints, and on what time frame. It's a very, very subjective thing, and I am of the mindset that we humans do not always make the right decisions, and sometimes it's best to just leave it up to when there's an opportunity to take a certain level of subjectivity out of your trading. And really anything in life, I think that can often be a good thing. So that's the third reason for why we're not going to use market orders. So if you haven't been using market orders, I really, really encourage you to try and implement this into your trading, because out of everything that I have been teaching you throughout these videos, this is probably, for me, the most important takeaway of trying to implement pending orders into your trading. It's been an absolute game changer for me. So with all of that being said, what we're going to do now that you have the theory of how we're going to be implementing these tools is we're going to hop into the charts, and I'm going to show you charts that have already been charted up. So they might look a little bit messy. They'll have all of the tools that I have shown you on them, but we're going to look at all of these charts with those tools drawn up to find areas of confluence, and then hopefully that will connect some of the dots for you. So by the end of this video, you will have almost everything that you need to be fully equipped to pass your FTMO challenges. The only thing that you won't have is risk management and psychology, which are, of course, the most important things when it comes to trading. But in the fourth part, we're going to be going over risk management and how to approach the FTMO challenge with the right risk management, because it does change a little bit based on how your risk management might be if it was a personal account or if you're funded and so forth. So that will be in the fourth video, but when we head into the charts, we're going to bring this all together, and I think that it will make much more sense for you guys once you see how I do it. So let's do exactly that. Okay, so the first pair that we're going to go over is GN. Now, I've marked up the chart on the weekly, so it looks a little bit messy, but I wanted to mark it up before just so this video wouldn't be longer than it needs to be. So bear with me, it might look a little bit overwhelming, but once we put the pieces together, it will all totally make sense. So I have the key levels drawn up here that I have combined with our psychological round numbers. All of these are the most relevant prices in terms of what the market might hit soon. We have a fib drawn from this low to this high and these moving averages. So what we're going to do is we're going to look for where these confluences intersect. Then we're going to see how many confluences intersect, and then we'll be able to determine whether or not we want to take a trade there. It's really that simple. So the first thing that I see is with this 61 fib, we also have this round number at 1.92. This is a weekly chart. A 61 fib on a weekly is very significant, as well as a round number, especially on GN. GN works quite well with round numbers. So this is an area that we're absolutely going to be interested in taking a buy. So what do? We simply draw a box to keep our thinking clear. We want to get in just slightly above the 1.92 area, and we need the box to be wide enough to also include the 61 fib area. That is what our zone is. That should be very clear. Now, this is two confluences. Two confluences on the weekly is enough for me to take a trade, but we can also hop over to the monthly, nothing there, and the daily to see if there's anything else. And it doesn't look like it, but we do have this nice area now drawn up. What I like to do, since I eventually like to delete most of the tools that I've drawn up on my chart, I like to put a box just explaining why I have that box, because this might only hit in a couple of weeks, and by then I probably won't remember what the area is. So it just helps me trust it a little bit more. So that is what we have there. Let's hop back over onto the weekly to see what else we have. Now we're looking to see where they intersect. So up from the top here, I can see that we have this key level at 2.0 and the 0 fib level, which is just the high. Now, last time that we hit this area, we moved over 700 pips. So if the market were to come back up to this area, we would absolutely be interested in taking it. I would be interested in getting in. This is where it gets a little bit tricky because you have 2.0 and you have the key level all the way up here. So what we could do is we could simply leave the box this wide, but I would not put my pending order necessarily at the first area. I would wait for the market to approach this area, and then I would look to see if there's any more confluences that I could use, because this would require a fairly wide stop loss. But I am going to put it as red for a short. As you've seen, I do use purple boxes, which are more for a break retest type of style of trade. We're not going to go over that because it would take a little bit of time. But so we're just going to stick to the red and green boxes, which is totally sufficient. Okay, so we have this area here. What else do we have? Well, we have 1.90 and the 78 fib, but like I said, I don't really like to trade the 78 fib, so this isn't anything that I'm interested in. We have this buy here, this key level. We do have this trend line coming down, right? So this trend line is from that high to this, so this would be a third touch. And we have the round number key level at 1.97. So this is really a fantastic example for how we set up our boxes. So it's red for a short. Now, why did I place it over here? I placed it over here because the market has to move over to touch the trend line. If it were to spike up tomorrow, it would only hit 1.97 and it wouldn't hit the trend line. Thus, it would only be one confluence. So in order for that to happen, it's going to take roughly 12 bars, so 84 days for this to hit. Now, I know what some of you are thinking, that's ridiculous, Matt. I don't want to wait 84 days. We're going to be able to find setups on a lower time frame on the daily, but these setups, the likeliness of them working is probably 90%. So I don't know about you, but I would love to have a 90% win rate, and I would love to have trades that I can hold on for multiple days and just make a lot of money out of. And these are the types of setups that the weekly chart is going to offer. So that is why we have this here. So it is a trend line, third touch, and a key level. Okay, so that is really, really a great example. Now, I know from experience, since I've been trading GN, that we do have a lot of really solid short opportunities on the daily. So we're gonna hop onto the daily. I only really see these three setups on the weekly, which is totally normal. Sometimes you won't find any, sometimes you will find more. These are really serious setups that will take a while to develop, but that you don't want to miss. So we're going to hop over to the daily to clear things up a little bit for you, and we'll draw some more boxes. GN right now is super clean and super clear. We'll draw a fib from this high to this low. And we're interested in right here, taking a short from this area here. Why? It's a 38 fib. It is at 1.96, so it's a round number, and we have all of these EMAs. So super strong. We definitely want to take this. Now, if we look at how I've drawn my box, I have it first at the lowest confluence, which is this moving average. Then we have this one here, which lines up with the 38. So technically I could draw it like this, and then we would calculate how much room we need to leave for a stop loss. I do like drawing it a little bit above that 38 fib though. Just a quick note, guys, as I was editing this video, I realized that I didn't really talk in depth sufficiently about take profit and stop loss levels. So I want to quickly go over that. In terms of the take profit levels that we're going to be using, it's a little bit difficult to give you a complete explanation just because of how long it would take. It really depends on whether we're going to be swing trading or day trading. Now, this entire strategy is totally 100% valid for both of those strategies. For swing trading, it's a little bit more difficult, so we're going to focus a little bit more on the day trading aspect, but just know that this strategy totally works for both. Now, in terms of how we will place our take profit levels, usually I take about 50% of my position off the table once I hit 30 pips. 30 pips seems to be roughly a good movement before it's possible that we'll see a little bit of a pullback, at least when it comes to day trading. Usually usually I take about 50% of my position off at 30 pips, and then I let the rest run. Now, as for when I close the remaining part of my position, it really depends on the trade, and you're going to need to practice and see what works for you. If the trade was taken off of a 4-hour level, it's very possible that I will close the remaining 40% of my position at 50 pips and then leave a small runner, or I'll close the entirety of the position. However, if we took a trade based on the weekly charts, it's possible that I won't close any of my position at 30 pips and I'll start to take profit at 50 pips or even more. So it's a little bit subjective in terms of the type of trade that we're taking, and it's not a one size fits all. So I hope you guys all understand that. But the good news is that when it comes to stop loss levels, it's pretty much the same regardless of the type of trading that you're going to be doing. The way that it works is, as you know by now, we are going to be setting our pending orders at the first confluence. So we have a cluster of confluences, 3 confluences, say a fib, a key level, and a moving average. What we're going to do is we're going to be placing our pending at the very first confluence. Price hits that, we're in the trade. So the question is, where do we place our stop loss? How do we calculate our position size? The way that you're going to put your stop loss, it's very, very simple. You're just going to put it below, sufficiently below the lowest confluence. So you want to make sure that your stop loss is below all of the confluences that are behind the reason for why you're getting into that trade. So if all of your confluences are very close together, it's possible that you could have a much tighter stop loss. But if you're on the weekly or the monthly, and even often the daily, it's possible that those confluences could be 15 or 20 pips apart. So that doesn't mean that you put your stop loss at 20 pips. You need to use a stop loss that gives the trade a little bit of room to breathe. One way that I like to do it is I often ask myself, if the market were to break through all of these confluences and hit this level, would I be okay at getting stopped out? If the answer is no, I need to give it a little bit more room to breathe, because there's nothing more frustrating than getting stopped out only for the market to reverse right after you've gotten stopped out. So you need to give yourself a little bit of room to breathe. And I see a lot of traders messing up in this area because, of course, we want the tightest stop losses possible, best sniper entry so we can use the biggest lot sizes, but really a little bit of breathing room can go a long way in improving your success rate, your win rate, and really just growing your account and passing the challenge. So it's as simple as that. We're just gonna be placing the stop loss below all of our confluences, and as we continue the video, I think that will become clearer. So if you guys do have questions by the end of this, let me know in the comment section. I'll be happy to answer them. Let's get back into it. So let's see how much of a stop loss, how wide of a stop loss we would need. Say the market comes and it hits it here. We get in. This is a good example. If we want to include this moving average here, we need a stop loss of 63 pips. Don't totally love that. That's a little wide for me. So we'd say that we're not getting into the trade because of this confluence here. We're getting into the trade because of these confluences here, the 38 pip and these 2 moving averages, not the one above. We're not as concerned with this moving average. We're more concerned with this area here. So the size of this area is roughly 21 pips. So I would say you need to include that area, those 20 pips, and then probably at least half of what it is. So that would be 30 pips. This is what our stop loss would be, and this for me on the daily I would be comfortable with. So ask yourself, if you get into this trade and you get stopped out at this level at 1.96291, could you live with it? And for me, the answer would be yes. It would be frustrating if the market reversed and it worked, but I am comfortable with this. One other way you could do it is you could put your pending order closer to the 38 pip and not at this moving average. I do that sometimes and it allows you for a tighter stop loss or more room to breathe. So that's something that you need to experiment with. As I'm explaining this, I realize that there's a lot of idiosyncrasies and there's a lot of things that are dependent on the trade that just come purely with experience. So just understand that it will get easier over time, but every trade is a little bit unique, but it's still very objective. You still need to have your stop loss above all of your confluences. So keep that in mind. But it will get easier with experience. Now, in terms of our take profit level, let's say this were to hit, what we would do is we would draw a fib from here. This would be our new fib, and we would want to target the 38, just above the 38, which would give us a risk to reward of 2.83, which is totally fine. But we would probably take a profit before that. We would probably take our first profit at this level here because of the moving average, and then when we would leave the remaining position running for this 85 pips, and we would have our stop loss at break even. So whenever I take my first profit, my first TP1, I always move my stop loss to break even. That's something that's important to keep in mind, okay? So we have this setup here. Where else can we look to take a trade? We draw a fib from here. We bounce from here to here. We bounced out the 61 from here. We moved higher. We could look at the 61 here. It's a little risky. I don't love it, but this is something that you could look to take. 61 fib, 200 EMA, and not really a key level, but a little bit of a key level. There's another area that we could look for. In terms of shorts, of course, we want to be shorting. We got the 50 fib here. So we want to be shorting the 50 fib because we have this key level at 1.97, and then this 61 fib, which is also a key level with all of these wicks. So draw this from here, right? There's our short area, and here is our 50 fib area at 1.97. So we want to get in slightly before, and we short it. I hope this makes sense. So if the market were to move up all the way to this 50 fib area, we take it, but we could also retake it again if we retest it 84 days from now and we get this trendline third touch. So I hope that makes sense. I know it's a ton of information. We're going to go over one more pair, but I hope that everything is starting to sink in. So what I would do from this point is I would again add my text boxes for why I'm interested in these areas, and then I would clean up my charts. I delete the fib levels, I delete the key levels, I delete all of those things to keep it nice and clean, and then to just trust the boxes. Okay, so now we're gonna go over Euro New Zealand. Like before, I've already marked up the chart, so just bear with me, take a deep breath, and we'll go over everything and where we will take our trade. So on the right hand side, we have our key levels. Some of them are psychological levels like 1.71, 1.69, 1.632, not as psychological. So we'll start from the bottom. Now, of course, we'd be interested in taking a buy when the market hits this low. We moved hundreds of pips, if not thousands of pips, 830 pips the last time we hit this low. So we're absolutely interested in taking a buy from there when the market comes to touch it again. If we move to the high of things, we have this 61 fib that's drawn from this high to this low, okay? I hope you see that. It lines up with 1.735, which is a key level. We can see the wicks running across. So this is where we will be interested in taking a sell. We probably won't hit it this year, and we may only hit it well into next year, but I still like having it on our chart, so when we do approach, we know what the pair is doing and why we have this drawn up. Okay, if we now zoom in a little bit, we have 50 fib up here, which is also a key level. The key level we have a 1.7, 1.71. So immediately we have the 61 fib and the key level at 1.69. You see how these intersect? Boom, this is where we want to take a trade. Right here, we have our box. It might also be a trendline third touch depending on when it lines up. So let's make this accurate. It is 61 fib and also potential trendline third touch, okay, because depending on when it hits, these are going to continue to move down. 38, we've bounced off the 23. This is the 38 here. I think we're going to hit the 38 before sooner rather than later, so I don't think will hit this trend line. We could put it just in case. Okay, here's our previous low at 1.652. So I'm actually going to draw a purple box. I know I said I wouldn't go over the purple boxes, but all you need to know is that I would be interested in a break retest of this, right? So probably not interested in taking a buy from this area, but if we break it and then come back and retest it, I'd be interested in that. So we have that. This is our 38 fib. This is our 50 fib. 50 fib, there's not really a lot of other confluences around it, so not as interesting as the 61 fib. I think that's everything for the weekly. If I zoom out, I'll give you guys a peek of what we've got. So we've got this major low for the buy, major high, we've got this medium term low, then this short here and this short here as well. On the daily, we can see that this 61 fib lines up perfectly with this 200 EMA. That is beautiful. Now, I am more interested in taking this 38 fib immediately now. If we were to just refine this a little bit, I'm also interested in shorting this 38 and maybe the 50 as well, okay? Let's start with the 50. The 50 has all of these moving averages, so it depends on how quickly the pair can get to it. If it takes a really long time, these moving averages won't be anywhere near the 50 fib, so I won't be as interested. You could have your first pending, if we were to talk about stop loss and take profits, you could have your first pending at this moving average. I wouldn't. I would have it at this one or even at the 50, and then your stop loss, of course, needs to include the 50 fib and this moving average, right? So if we calculate the distance from the 38 to that, it's 6 pips. So you need to have a stop loss that at least includes it. Let's say you get in from the low here, it's 6, so if we were to double, it'd be like 12, but I'd say roughly 30 to 25 pips is what you would want to use. We would then redraw our fib, target the 38, maybe multiple levels. With the price action that we've seen, I'm definitely expecting maybe to retest this low. So this would be a potentially more of a swing trade. If we break through, then we'd be entering on the 61, which we have here. The 61 is incredibly interesting. I'm looking forward to trading this. We would get in probably at maybe 1.69. And then we'd have our stop loss just above at 30 pips. It would include all of this. So 1.69, the key level, is the first confluence, so that's where we'll be entering. If you don't want to take that and you want really just a safer entry, you would enter at the 61 fib, and your stop loss would be sufficiently above that. Okay? Are there any other setups? Yeah, I said the 38 I'm also interested in taking. So we've got this here. In terms of buys, we've got this buy that's lower. We need to move higher to be able to redraw our fibs to then find a buy. So really I'm more interested in sells on this pair, and that is that, okay? So you can look at all of the boxes. Now I would clean up my charts. I would delete the fibs. I would probably delete some of the key levels, and then I would leave the moving averages on, but you can see it clearly. And I like to leave the trend line, so that's how I do it. I hope all of that makes sense, guys. I know it was a ton of information. This video will probably have the most information out of the 3, so I encourage you to watch it back a second time if you still have questions, if you're still wondering how it works. It takes a little bit of practice, but really all you need to know, the theory behind it and the mechanics behind it, is you just need your stop losses to be sufficiently above any confluences. You're taking trades in areas where confluences align. So think of it like a spider web. You draw up all of your tools. Don't even think about where you're gonna get into a trade. Drop all of your tools, look where all of these lines intersect, and that is where you're gonna put your box. That's where you're gonna put your pending order, and then you walk away and you let the market do whatever the market wants to do. And over time, in the long run, you will be a profitable trader. You'll pass your challenges and you'll be totally good to go. In terms of take profits, we're always closing a portion of our trade when we hit the first resistance. So if we're approaching a 38 fib, a moving average, whatever it is, we're gonna close a portion of our position. Often I start with 50%, move our stop loss to break even, and then depending on the trade and depending on the situation, we will then target further levels. Sometimes they're smaller trades, sometimes they are larger trades. It really depends on the situation. I'm sure you guys have lots of questions, so let me know in the comment section what they are. I'm really enjoying this series and hearing that you guys are getting a lot of value from it. Next week we'll have the last part where we go over the risk management side of things, so I'm looking forward to that. Thank you guys for watching. I'll see you in the next video. Peace.